Moving on now, top sources have told NDTV Profit that the government is likely to rectify key drafting errors in the proposed new income tax bill. The move assumes significance as the draft bill had proposed expanding the scope of minimum alternative tax to LLPs, effectively making them liable to pay a higher long-term capital gains tax of 18.5%, which understandably triggered industry concerns. My colleague Shrimi, however, joining in with more details on this. Shrimi, over to you.
Well, it looked like some big relief on the cards for both corporates and non-corporates entities, as government is set to make some key correction in the proposed income tax bill in line with the select parliamentary panel's suggestion. Now, sources tells us that there are certain drafting errors which could be rectified in the proposed bill, and that will be reflected in the final bill. Now, the provisions and sections in the draft bill, and some of them are actually creating quite a stir among investors as well as taxpayers on the tax treatment. And one among those is with respect to the long-term capital gains on the limited liability partnership and similar sort of partnership firms. So what happened here is that the draft bill actually proposes to expand the scope of, alternative minimum tax for LLPs. Remember, in the existing Income Tax Act, the alternative minimum tax applies to only those LLPs if they claim certain deduction on it. However, that particular rule has been removed in the draft bill, which is making the whole, LLPs and the family offices jittery, and now they are seeking explanation as it increases the tax rate to 18.5% from existing 12.5%. Similarly, on the corporates claiming deduction on the dividend has been also removed. Sources tells us that it was omitted inadvertently in the draft bill, and that will also something will be restored in the final set. Certain provision with respect to nil TDS refunds are also some provision which are kind of creating confusion and could be restored in the final sort of bill. Now, sources said that the government has accepted all most of the suggestion of the parliamentary panel, which is around 285 suggestion, mostly directed towards the rectification in the draft bill, and they are very clear on the fact that there is no policy change in the draft bill, which, with respect to any tax rate change, etc. And in fact, the bill is listed for the passage in the ongoing monsoon session. However, given the kind of tweaks and changes which is required in the draft bill based on the suggestion, it could take some time. And that is why the passage of the bill could differ for the next parliamentary session. However, no decision has been taken so far. So for now, the bill is listed. However, we need to see whether it will be moved for passage in the ongoing session or not.